Imagine waking up each month to $5,000 in your account without lifting a finger. Sounds impossible? Well, it's not. In fact, many people are using dividend stocks to do just that. Generate a steady stream of passive income. The best part? You can too. In this video, I'm going to break down how you can build a portfolio of the right dividend stocks to start earning $5,000 a month in passive income. This isn't some get-rich-quick scheme. It's a proven strategy that works if you follow the right steps. I'll walk you through exactly how much you need to invest, what kind of stocks to choose, and how to maximize your returns over time. By the end, you'll have a clear plan of how to turn your investments into a reliable source of income, no matter what the market is doing. Ready? Let's get started. Chapter 1. The $5,000 Goal. How much do you really need to invest? So, how do you actually get to $5,000 a month in passive income from dividend stocks? The first thing you need to understand is how much money it will take to reach that goal. Let's start with a scenario where you want to generate $5,000 right now. If you invest in high-yield dividend stocks, which typically offer a return of about 7%, you'll need to invest around $700,000. Here's how the math works. $5,000 a month equals $60,000 a year. Divide that by 7%, and you get the $700,000 investment needed to hit that income target. Now, let's say you prefer a lower risk approach by investing in safer options like index funds or dividend-focused ETFs. These usually offer a lower yield, around 3.4%. In this case, you would need a much larger investment, about $1.76 million, to generate the same $5,000 per month. Why? The lower yield means it takes more capital to produce the same amount of income. But don't worry if those numbers sound huge. You don't have to come up with all that money right away. You can start with smaller amounts and gradually build your portfolio over time. The key is to keep reinvesting your dividends, allowing your money to grow through compound interest. The most important thing is knowing how much capital you'll need based on the type of dividend stocks you choose. Whether you're comfortable with a high-yield strategy or prefer a safer, long-term approach, understanding the numbers helps you plan smarter. We'll cover more strategies later on, but for now, let's focus on how patience and time can work in your favor. Chapter 2. Time and Patience. Compounding and the Power of the Dividend Snowball. Here's where the magic happens. Time and patience. One of the most powerful forces in investing is compounding, and it works wonders when you reinvest your dividends. This is what's called the dividend snowball effect. And just like a snowball rolling down a hill, it gathers momentum over time. Let's break it down. When you receive a dividend payment, instead of spending it, you reinvest it back into buying more shares. These additional shares then generate even more dividends during the next payout. As this cycle repeats, your investment grows at an accelerating rate. It's not just about linear growth. It's exponential. The longer you keep reinvesting, the faster your income will grow. For example, let's say you start with a $100,000 investment in a stock with a 5% dividend yield. At the end of the year, you'd earn $5,000 in dividends. If you reinvest that $5,000 next year, you're earning dividends on $105,000 instead of $100,000. Over 10, 15, or 20 years, this compounding effect can turn a modest investment into a substantial income source. The key here is patience. Dividend investing isn't about getting rich overnight. It's about allowing your investment to grow over time, using the power of reinvestment. The more time you give your portfolio, the larger your dividend snowball becomes. Before you know it, you'll be earning far more in passive income than you started with. Chapter 3. Selecting the right dividend stocks. balancing yield and growth. When it comes to picking the right dividend stocks, it's all about balance. On one hand, you have high-yield stocks that offer big payouts right away. On the other hand, there are lower-yield, growth-focused stocks that can provide steady long-term gains. The challenge is finding the right mix of both. Let's start with high-yield stocks. These stocks, like British American Tobacco or Altria, often have high yields as high as 7 to 8%. While this means more income up front, it also comes with more risk. These companies usually operate in industries facing challenges, like tobacco, which can affect the long-term stability of their payouts. However, if you're looking for immediate income, these can be great options. Next, there are growth-focused stocks. Take Apple, for example. Its dividend yield is much lower, around 0.5%. But Apple is a company known for growth. While the dividend payments won't be as large initially, the potential for stock price appreciation is much higher. This means your investments could grow in value over time while still paying out dividends. So, how do you decide? A balanced portfolio is key. You might allocate a portion of your investment to high-yield stocks for immediate income and the rest to growth stocks for future gains. This way, you benefit from both the regular dividend payment and the potential for capital appreciation. Diversification also plays a role here. Don't put all your eggs in one basket. Spread your investments across different industries, like tech, utilities, and consumer staples, to minimize risk and keep your dividend income flowing, even if one sector underperforms. The right combination of yield and growth will give you the best chance to build a solid, sustainable income stream. We'll explore specific stock samples next to help you see how this works in practice. Chapter 4: Realistic Portfolio Building Strategies to Hit the $5,000 Goal. Now that we've covered the basics of selecting dividend stocks, let's talk about how to actually build your portfolio to hit that $5,000 a month goal. There are two main strategies you can follow, depending on your financial situation and risk tolerance. Strategy 1: One-time lump sum investment. If you have a significant amount of capital upfront, you can use a lump sum approach. For example, by investing $700,000 in high-yield dividend stocks with an average return of 7%, you can start generating $5,000 per month right away. This strategy is ideal for those who want immediate income and can handle the potential risks of high-yield stocks. However, remember that diversification is key, so don't put all your money into one or two stocks. Strategy 2: Monthly contributions over time. If you don't have a large sum to invest, don't worry. You can still build up your portfolio through regular contributions. For instance, by investing $200 each month in a diverse range of dividend-paying stocks or ETFs, you can gradually build a portfolio that produces $5,000 a month over time. This method works particularly well when you reinvest your dividends, allowing your income to compound and grow year after year. Both strategies can work, but it's important to choose one that matches your goals and current financial situation. The key is consistency. Whether you're investing a lump sum or smaller amounts regularly, sticking to the plan will help you reach your goal. Chapter 5: Examples of dividend stocks that can build your income. Let's dive into some real examples of dividend stocks that can help you reach your goal of $5,000 a month in passive income. We'll look at a mix of high-yield stocks for immediate income, stable long-term payers, and other assets like REITs and ETFs that provide diversification. High-yield stocks for immediate income. If you're looking for stocks that pay high dividends right away, consider British American Tobacco, or BTI, which offers a dividend yield of 8.4%. While this provides a strong cash flow, keep in mind that the tobacco industry faces challenges like declining smoking rates and regulatory pressure. Still, BTI has maintained its high dividends, making it a good option for short-term income. Another solid high-yield choice is Altria MO, with a yield of around 7%. Like BTI, it's a tobacco stock that carries some risk, but Altria has been a reliable dividend payer for years. This can be a good option for investors willing to accept a bit more risk in exchange for higher immediate returns. Stable long-term dividend payers. For those more focused on stability, Apple or AAPL is a great example. Though its dividend yield is just 0.5%, Apple is the largest dividend-paying company in the world. Its massive cash reserves and consistent growth make it an excellent choice for investors looking for short-term gains with steady, albeit smaller, dividend payments. Procter & Gamble, PG, is another solid option for stable dividends. With a yield of about 2.5%, it may not provide the highest payouts, but PG has a long track record of increasing dividends year after year, making it a reliable choice for conservative investors. Telecom and utilities for consistent dividends. If you prefer something more defensive, Verizon VZ offers a 7% yield and is known for steady payouts. While its stock price hasn't performed well, Verizon continues to generate solid dividend income, making it a popular choice for income-focused investors. Duke Energy DUK, with a 4% yield, is a strong player in the utility sector. Utilities tend to be less volatile during market downturns, providing consistent dividend payouts that can weather economic storms. Real Estate Investment Trusts, or REITs. REITs are another great way to generate passive income. Realty Income, or O, often called the monthly dividend company, offers a 4.5% yield and pays dividends every month. It's a solid option for those seeking regular income from real estate investments. American Tower AMT is another REIT worth considering. Focused on digital infrastructure like cell towers, AMT provides a 3% yield and benefits from long-term growth in the communications sector. Dividend ETFs for broad exposure. If you want diversification, consider Vanguard High Dividend Yield ETF, or VYM, which offers a 3% yield and invests in a basket of high dividend stocks across various industries. Similarly, Schwab US Dividend Equity ETF, or SEHD, provides a 3.4% yield, offering a mix of dividend-paying stocks in a single, easy-to-manage fund. By investing in a combination of these stocks, you can create a balanced portfolio that generates consistent, reliable income, while also allowing for growth over time. Chapter 6. Putting it all together. Now that you know how dividend stocks work and what kind of stocks to invest in, it's time to put it all together. Achieving $5,000 a month in passive income won't happen overnight, but with the right strategy, it's absolutely possible. The key is to be consistent. Whether you start with a lump sum investment or make smaller, regular contributions, stick to your plan and reinvest your dividends whenever possible. Choose a mix of high-yield stocks for immediate income and stable, long-term growth stocks to create a balanced portfolio. Diversifying your investments across different sectors will also help minimize risk. Dividend investing is a long-term game. It's all about patience and letting your investments grow over time. With dedication and the power of reinvestment, you'll be well on your way to achieving financial freedom through passive income.